Peter Coleman, thanks for joining us.
Pleasure.
Now, you said today that Woodside has up to $40 billion worth of projects coming down the pipeline into the future. Talk to us about what an important time this is in Woodside's history.
Well, it really goes back to the beginning of the decisions we made around the Northwest Shelf, and if you put that into context, at that time the decisions, particularly around the project financing, were the largest ever done globally. We're making very, very important decisions today. If you think about not just the $40 billion, but also the amount of reserves that will develop, it'll actually triple the size of Woodside's reserve base. And a reserve base is what a resources company works off. So you think about tripling our size. We're about to develop twice as much gas as we've actually produced in the last 35 years since we've been producing. So it kind of gives you an extent of the scale of it. And it's going to provide a 6% compound annual growth rate in our production between now and 2028. So very, very significant decisions. In fact, we've not been faced with significant decisions this significant really since the start of the company.
So on a couple of those projects, there were reports this week that Woodside was considering reversing its decision to sell off a $16 billion stake in the Scarborough project. Can we speak to that for a bit?
Well, there's two parts to Scarborough as we look at it. There's what we call an upstream part, or the offshore, where the resource itself is, so where the gas lies under the ground. And then the second part to it then is the infrastructure that we'll build onshore at our existing Pluto facility. So we'll build what we call another processing train there. It's the upstream part of it. We've said, well, currently we're 75% ownership in that. We've said, you know, the more we look at this resource, actually the more we like it. And one of the hardest things to do in the resources industry is actually find a world-class resource very close to your existing business. So we're looking long and hard at that and saying, well, unless we get really full price, meaning, you know, the right partner at the right time at the right price, then I think our shareholders will want us to keep that. That's a different investment decision to the processing train. We think the processing train actually is set up very nicely for infrastructure, and we're starting to talk to infrastructure investors who may wish to participate in that.
And on Browse, there's also been reports that there's concerns among those potential partners in Shell and BP that perhaps they're not as enthusiastic about Browse because of higher carbon emissions.
Well, the project itself is moving forward. So all of the partners have committed to going to what we call front-end engineering and design, or FEED, by the end of this year. Now, of course, that's predicated on us being able to complete a gas processing agreement to treat the gas and turn it into LNG at the Northwest Shelf plant. But that's very, very close. So you know, I'm hopeful we'll still get that done by the end of the year. We really haven't talked a lot about carbon. What we have agreed at this point, though, is each of the partners will take on the carbon obligation themselves. Whereas historically, for example, you might do that as a joint venture. We've actually said, because each player has their own options out there, each owner, then they'll look after that obligation themselves. Woodside's recently announced a relationship with Greening Australia, who we think are the very, very best at creating carbon sinks in Australia, and we're literally out buying properties right now to be able to start creating those carbon sinks. So that's us getting ready for a future where Browse is in our portfolio.
Let's talk about hydrogen. How much of Woodside's future do you see in hydrogen production?
Well, we've got to focus on the base business. So you talked about that $40 billion of investment coming through the pipeline. That's really our base business now for the next 20, 30 years and beyond. And that's going to provide tremendous growth for the company. And that's what we've been really good at. But we also recognise that there are two transitions going on globally at the moment. One of those, of course, is a technology transition, and the other one is an energy transition as we look at what our global carbon obligations are. And we're actually in both of those. We started on the technology transition about 5 years ago. And of course that collaboration has led us to be leading innovators in the use of data analytics and of course artificial intelligence, and more recently robotics. On the energy transition, we look at it and say you have to be about 10 years ahead of when you think things are going to be commercial in scale. And for us, a natural complementarity in our business, or something that we know how to do already, very complementary to what we currently do, of course, is hydrogen. And why hydrogen? Well, of course, we can make hydrogen out of renewable power. We have a lot of that in the Kimberley. Woodside's very used to dealing with product at industrial scale that's very, very cold, and that's what hydrogen needs to be. We're very competent at shipping at large distances, and of course the target markets, those markets that need hydrogen the most, are Japan, South Korea and China, and of course that's where we sell our product to already. So that's the logic behind why Woodside's interested in hydrogen.
You made some comments about the Australian corporate tax regime. Are you confident that under the Morrison government there will continue to be a push to reform corporate tax structure in Australia? Because prior to the election the business community really kind of raised a white flag on that one.
Well, I think what we have to do is just keep the debate going, whether it's in the next couple of years or beyond. We shouldn't give up on fundamental tax reform because fundamental tax reform is needed. I think most people recognise that. It's just, you know, good ideas aren't always there at the right time, and so it's about finding the right time for that and the right environment in which fundamental tax reform can take place. I did acknowledge that the Morrison government has already made steps in that regard in reducing income tax, personal income tax, which is a great first step. But what we're calling for today is really saying, well, let's have a look at maybe some of the other areas of taxation, such as depreciation rates and so forth. So if we're not going to lower the tax rates, then let's have a look at, for those who are investing in the future, those who are actually growing the country and growing the economy, let's reward those companies through depreciation rates on those investments. I'm not talking about broad scale for people who don't do anything. If you're not doing anything and all you're doing is what you did yesterday, no, you shouldn't get a tax break simply because that was a good idea. No, if you're going to invest though, if you're going to risk your money, if you're going to create new jobs and new wealth in the economy, then our call is let's have a look at those mechanisms that help do that.
Peter Coleman, thanks for your time.
Pleasure. Thank you very much.